Good afternoon, viewers. My name is Imran. I'm a UK and international tax specialist. Once again, I'm here with another interesting video. In this video, I will explain to you the partnership and its partner self-assessment in the UK. So this video is with illustration and example, which will make it very easy for the viewers to understand the concept. And after watching this video, you will definitely do well in exam and in practice. I suggest you do not skip any part of this video because there are lots of useful information in this video which will benefit you. Also subscribe to my channel because I'll be making more interesting video like this. I will be covering the whole UK taxes, which include employment taxes, corporation tax, capital gain taxes, inheritance tax, and I will also doing financial reporting and financial management. Understanding the general rules. So this topic is highly tested in ACCA, ACA, and CTA taxation exam. It's also helping viewers in understanding the partnership taxing. This video is with illustration, which will make it very easy for the viewers to understand the concept. So let's begin. Introduction to partnership. A partnership is two or more individuals work together in a trade with a view to making a profit, or where person carrying on a business in a common with a view to realize profit. So if the business make a profit, they share a profit, and one individual does not employ the other. So they are partners. So there is no, the one does not employ others, so they work together to realize a profit and then share the profit. So the partner will have a partnership agreement which lay out the terms and understand how the partnership should be managed and how dispute could be resolved. So the agreement should cover how the profit and loss of the partnership will be split. For example, 70-30 or 40-40-20. For example, if there are three partners or there are two partners, so it should stipulate how the profit will be split. The agreement should also set out rules for admitting a new partner or retiring an existing partner. Types of partner. Equity partner, those who share in profit and losses and play an active role in running business. So they provide equity, and at the same time, if there is a loss, they provide further equity. They also are actually involved in running the business. Salary partner, this appear to be partner, however they're usually senior employee of the business or person who spent a significant time in the business, so they use the title as partner. However, they're not actually partner, but they're using the title partner. They normally have a fixed salary and do not participate in profit share. If the business or a partnership make a loss, they do not participate in loss. Sleeping partner, who participate in profit and loss sharing but do not play a part in running the business. So this will be a case of a person who is engaged in various businesses, who invest in various businesses but do not actually involve in running or managing those businesses. So that's called sleeping partner. Corporate partner are the partner who are a limited companies or a corporate body. So this one will be the case of the mixed partnership, where an individual and a corporate member group together and form a partnership. So in this case, there will be a member called a corporate member in a mixed partnership. Very important to remember tax treatment of a partnership. Remember, the partnership itself does not pay any taxes. However, they are required to file a return. So once they file a return, they must do so by 31st of January following the end of the tax year. The same as we're doing self-assessment for individual. So once HMRC received the partnership return, they would see the name of each partner with unique tax reference number, their date of birth, and then HMRC would expect the partners, the individual or corporate partner, they should declare those income on their self-assessment. So they can see the partnership return first, and then the individual will receive the copy of return, and they would declare those income or the profit they receive from the partnership on their self-assessment. However, the first thing you need to remember is the first step is to adjust the accounting profit to arrive at the taxable trading profit. For example, if a partnership accounts for accounting period ended 31st, AP stand for accounting period, ended 31st December 2022, show a profit of 120,000. In accounts, there are disallowed expenses of 15,000 relating to depreciation, client entertainment, and capital expenditure. The available capital allowance is 20,000. So first thing, even in exam, if you're sitting down, so you will receive a set of information from examiner you have to make several adjustments. So you're doing the same thing like the way you do for the company. So you start with accounting profit for the accounting period. So in this case, we start with the accounting profit of 120,000. Then we add back disallowed expenses. So we add back client entertainment, depreciation, and any other capital expenditure, and then we deduct the capital allowances, or we claim a relief for capital allowances. In this case, we get tax adjusted profit, and that profit will be split on each partner. So the first thing is you need to adjust that profit. So start with accounting profit for the accounting period, make adjustment, disallow the depreciation, disallow client entertainment, disallow other capital expenditure, disallowed other expenditure that is not for business or for personal reason. For example, client partners using partnership money for their own entertainment, so disallow those expenses as well, and then claim a relief for the capital allowances. This will give you the tax adjusted profit. So that's the first step you need to do in practice and in exam. Start with accounting profit, and then make adjustment for disallowed expenses, and then claim a relief for capital allowances. Now, tax treatment of partnership, remember, so after dealing with the first step is to work out the tax adjusted profit. So start with the accounting profit, and then add back disallowed expenses, claim a relief for the capital allowances. After that, the next step is to allocate the tax adjusted profit to the partner, which will be based on the partnership agreement. Remember, it is a common or basic understanding when the people working together or form a partnership. So they would stipulate an agreement. They will make an agreement. Agreement will show which partner, how much they need to contribute, how the profit and loss will be shared, how much each partner would need. For example, if a partner contribute a lot, so obviously he will be entitled for a bigger amount of profit. So that's just very basic things a person need to understand. Even this, you don't need any knowledge or accounting knowledge for this one. So when someone forming a business together, they make an agreement. So agreement will show how the profit will be divided. If there is a profit, for example, if one partners contribute a lot than other, and then putting a lot of efforts in the business, obviously this would say, oh, he has more experience in running business, so definitely he will be entitled for a bigger profit percentage. So in this case, continue to the previous example now. So obviously there will be an agreement. Without agreement, we don't do any business together with any individual. So there must be an agreement. An agreement will show the profit sharing ratio. Now continuing to the previous example, now assume there are three partners, Cole, James, and Junior, agreed to share profit on 40, 30, and 30. So total is 100. So based on the Cole share will be is 40 divided by 100 multiplied by 115,000. Remember the tax adjusted profit. So the HMRC would receive the figure of the tax adjusted profit, and then on the partnership return we will show how much each partner receives. So we will tell HMRC that the Cole received £46,000 income, so the Cole must declare those income on his self-assessment. James received, so 30 divided by 100 multiplied by 115,000. James received 34,500. Junior received 30 divided by 100 multiplied by 115,000. Remember the tax adjusted profit was 115,000. So now HMRC, after we file the partnership return, HMRC will see it clearly that the Cole, James, and Junior receive those income. If the Cole and James have property income, other income, employment income, they would also put this on their self-assessment. That's how the purpose of the self-assessment is. So these profit share will be shown on the partnership tax return, and then each individual will report their income on their self-assessment. So how easy is that? So work out the tax adjusted profit. In exam, you have to make plenty of adjustment and then allocate those profit to each individual based on the profit sharing ratio. And this profit share will show on the partnership tax return, and then each individual will report their income on their self-assessment. Very important from exam perspective and from practical point of view. When a partnership is formed, it must be registered with HMRC by a nominated partner. The nominated partner is responsible for completing and filing partnership return with HMRC by 31st January following the end of the tax year. HMRC will penalize partnership for late filing or non-filing. For any inaccuracy in the return, each partner will be liable to a penalty for inaccuracy, and An inquiry in the return will affect the partners on the return. So you need to remember the partnership must be registered when you form with HMRC. Then the partnership need to file the return by 31st of January following the end of the tax year. HMRC will penalize the partnership for non-filing or late filing. For any inaccuracy or there is a error in the return, each partner will be liable for a penalty for inaccuracy. An inquiry in the return will affect the partner owns return. Very important to remember the rules. Profit share mechanism, very important. The partners are taxed on the profit share. If partner have a drawn profit during the year, this will be simply ignored in the tax computation. Drawing cannot be treated as an expense because you cannot wait for the end of the year. If there's a profit, the partners can withdraw the profit. So this will be just considered as an early allocation of profit. They cannot treat this as an expense just to reduce their taxable income. They will be assessed on those withdrawing. So the drawing cannot be treated as an expense, and this cannot reduce taxable profit. Some partnership may agree that certain partner will receive salary because some partner may be hardworking and they want salary because of their family's issues. So some partners will like to have some salary for their hard work, or maybe they're starting early or they're finishing late. So this will be still considered as initial allocation of profit. Such fixed salary of partners are not taxed as an employment income because the partners are treated as self-employed. Remember the rules, okay? Such salary is just giving away of a giving partner a priority allocation of a trading income. So do not confuse this with wages received by employee. Partner may receive an interest on capital. Again, this will be treated as an allocation of profit. Here's the illustration, very important. Simon and James are in partnership. Profit for the year to 31st December 2022 is 140,000. Simon and James agree on profit sharing ratio of 70 and 30. But after paying Simon a salary of 10,000 per annum because Simon works long hours, interest on capital to Simon and James are 5,000 and 4,000 respectively. During the year, Simon withdrew 40,000 and James withdrew 30,000 from the partnership account. So it's very common practice that partners taking the money out because people have the family needs. They need to feed their family. So they don't have to wait for the end of the year. They can withdraw money from the partnership. However, this will be just considered as early allocation of profit. This cannot be considered as an expenses of the partnership. Demonstrate how 140,000 profit for the year will be allocated between Simon and James. Now, very important. Hence, the information relating to drawing is irrelevant for tax computation. Simon and James will be assessed on their profit share from partnership based on 70 and 30 as mentioned in illustration 1. Salary of 10,000 received by Simon is the prior allocation of profit. Interest received by Simon of 5,000 and James 4,000 is the pre-allocation of trading profit. So these cannot be treated as an expenses. These are just the prior allocation of trading profit. Now, this is illustration number 1. We still continue with illustration number 1. If there is a need for adjustment, you will do the adjustment. However, we don't have such information. Here is, so we start with the trading income. So there's no adjustment needed because we don't have information. If there's information, for example, there are some disallowed expenses and there is some capital allowances, you need to add back disallowed expenses and claim capital allowances. So here in our case, the trading income is 140,000. Take the Simon salary out. So allocate 10,000 to Simon. That's called prior allocation of 10,000 to Simon. And then the partner interest on capital. So this is a prior allocation of interest to Simon and James, 5,000, 4,000. So then after that 140,000 minus 10,000 minus 9,000 is give you a residual profit, and then divide this residual profit using the profit sharing ratio of 70 and 30. So for Simon, you need to do 121,000 multiplied by 70 divided by 100, and for James is 121,000 multiplied by 30 divided by 100. That would be for James. So the Simon profit share is 99,700 and James profit share is 40,300. This will be reported on the partnership return. Simon would also show 99,700 profit on his self-assessment for 2022-23, and James will also show 40,300 on his self-assessment for 2022-23 from the partnership, along with other income, for example, wages. If they have rental income, they receive a dividend. This must be reported all together on his self-assessment. Remember, the partnership can also have other income in addition to trading income. So other income such as rent, interest, investment income is chargeable on the same current year basis until 2022-23. Remember, because there are reforms in the current year basis, I have made a separate video on the current year basis reform. You must just visit video. This would apply from April 2024. There's a transition period, which is 2023 and 24. So the other income will be split based on the profit ratio, share ratio for that accounting period. Partner will be taxed using the current year basis. Similarly, dividend income received by partnership is allocated to partners using the profit sharing ratio of the accounting period and then a portion to the tax year. Normal commencement, cessation, and overlap rule will apply when the partners join or leave the partnership until 2022 and 23. Because after that, there's a new reform scheme. I made a separate video on the reform for the current year basis. You must visit that video to understand what are the reforms. Now, illustration number 2, Jones and Julie are in partnership with a profit sharing ratio of 50-50. Just for simplicity, for the year ended 31st December 2022, the results were as follows. They had the trading profit of 50,000. They have rented the partnership has a trading profit of 50,000 and the rental income of 10,000. The partnership also received dividend in February 2022, 500, and in September 2022, 800. So the total dividend is 1,300. So the total profit for the partnership is 73,000. How the income will be taxed on each individual, I'll show you on the following slide. So remember, again, make 3 columns total, then John and Julie. If there's another partner, make another column as well. So the trading profit of 50-50. So the trading profit is 50,000. So 25,000 to John and 25,000 to Julie. Rental income of 10,000. So 5,000 each. Both the trade profit and the rental income are taxed on John and Julie in 2022-23 on the current year basis. This will be reported on their self-assessment. Dividend are apportioned on the relevant tax year. So dividend is slightly complicated. They are not assessed under the current year basis. Remember, one part of dividend, this £500, were received in February 2022, which falls in the tax year 2021-22. So £250 to Jones and 250 to Julie. Then the other portion of September that falls in 2022-23. So then again, that was 800, so 400 to Jones and 400 to Julie. Again, this amount will be declared on the John and Julie self-assessment for the relevant tax year. So in summary, a partnership must have a partnership agreement which would show how the profit and loss will be split, how each partner will be, who will be doing what. Obviously, a business have an agreement is formed between 2 or more individuals. So there must be an agreement. And then the second step we need to remember is when someone making a partnership, it must be registered with HMRC. Then each year the partnership a nominated partner must file the return to HMRC, and then each partner must declare those profits they receive from the partnership on their self-assessment along with other income. Remember, HMRC doesn't tax a partnership, but the partnership must declare the income. So based on that, the HMRC can see how much income is received by each partner, and then the HMRC would expect that each partner must declare those income they receive from the partnership along with the other sources of their income on their self-assessment. So when it's come to the partnership, we still having the accounting period. We make the accounts for a partnership as usual. So when it's come to the return, you start with accounting profit, make adjustment. That is the first step. If you see it's something, an exam like this, pick up the accounting period profit, then so just do not panic with the current year basis rule or any transition. Start with accounting profit, make the relevant adjustment, get the marks. So relevant adjustment, add back depreciation, add back disallowed expenses, add back other expenses that have been taken out for partner, any medical treatment for the partner, any other treatment. For example, they have some benefits, so partner benefits are disallowed as well. Then claim a capital allowances. If there's a need to do the capital allowance computation, I have make other videos on capital allowances. You should watch these videos on the capital allowances, so then you can do the capital allowance calculation. So claim a relief for the capital allowances. After that, once you calculate the tax adjusted profit, then allocate to each partner. So this is the second step. And then after that, if the partner is been from a long time, so that would be assessed based on the current year basis. If the partner just joined in and that's the first year, so then the current year basis would apply. Remember, 5th of April. Should you remember the rule? And then finally, thanks for watching. I hope you found this video useful. Remember, once you have the knowledge, the examiner cannot trick you. You will also perform well in practice too. My aim is to give you confidence, knowledge that you need for exam and in practice. Hence, your chances of employability will be high. Do not forget to share, like, and comments. Also hit the subscribe button because I'll be making more useful videos like this to benefit you. Now, I already make a video on the current year basis reform. However, the next video will be is how the current year basis will affect the partnership, and then I will be making video on capital gain taxes and inheritance taxes, financial reporting, and financial management. Thanks for watching. Now it's time to wish you a pleasant evening.